right, this is problem 5-8, and it is something that is similar to what you might see on the CPA exam. So anyway, I'm not sure where I stopped talking, but this problem is a CPA type problem, and it questions your knowledge about elimination entries and consolidated financial statements without you having to do an entire worksheet with eliminations and everything. All right, so anyway, presented below are selected amounts from the separate and consolidated financial statements of Petto Corporation and its 90% owned subsidiary, Sean Company, at December 31st of 2016. And we have income statement items, and then we have selected balance sheet amounts. Then we also have retained earnings, net income, and dividends paid. All right, then they tell us on January 2nd of 2016, Petto purchased 90% of Sean's 100,000 shares outstanding common stock for cash of $175,000. On that date, Sean stockholders' equity equaled $150,000, and the fair value of Sean's assets and liabilities equaled their carrying amounts. Any remaining excess is considered to be goodwill. On September 4th of 2016, Sean paid cash dividends of $30,000, and that's that right here. On December 31st of 2016, Petto recorded its equity in Sean's earnings. And that is up here. All right, items A through C on page 311 represent transactions between Petto and Sean during 2016. Determine the dollar amount effect of the consolidating adjustments on 2016 consolidated net income. Ignore income tax considerations. All right, so these are their separate income statement items before any adjustments have been made. And let's see what they tell us on the next page. All right, so we need to do 1A. On January 3rd, 2016, Sean sold equipment with an original cost of $30,000 and a carrying value of $21,000 to Petto for $36,000. The equipment had a remaining life of 3 years and was depreciated using the straight line method. Okay, so currently on Sean's books, there is a gain of $15,000. All right, and that gain is, the sale price was $36,000. The book value was $21,000. So that's where the gain came from. All right, but they sold it to Petto, so when they consolidate, you can't recognize the gain. Right? So the gain of $15,000 is eliminated. Oops. But you get to recognize it by decreasing depreciation expense. So it has a remaining life of 3 years. So 15,000 divided by 3 equals 5,000. A deferred gain recognized this year. So net decrease to income will be $10,000. All right, it's going to go down by the 15 that you have to eliminate, but then you get to reduce depreciation, which increases income by 5. So the net there is 10. All right, 1B. During 2016, Sean sold merchandise to Pero for $60,000, which included a profit of $20,000. At December 31st of 2016, half of this merchandise remained in inventory. Okay, you can't recognize the gain included in ending inventory. So it's half of 20,000. So 10,000 will be eliminated, and income will go down by that 10,000. All right, C. On December 31st of 2016, Pero paid $94,000 to purchase 50% of the outstanding bonds by Sean. I don't know about Sean. The bonds mature on December 31st of 2022 and were originally issued at a discount. The bonds pay interest annually on December 31st, and the interest was paid to the prior investor immediately before Pero's purchase of the bonds. Okay, so we need to see if there's a gain or a loss. We don't need to worry about eliminating the interest because it was paid to the person that owned the bonds before P bought them. All right, so let's go back a page. All right, so here is the investment in bonds. Here are the bonds. I thought they paid 94. Okay, well, anyway, here are the bonds. So the bonds payable are 200 minus a discount of 9. That looks a little better. And we bought half of that, right? This is at December 31st of 2016. I'm going to go back over here. I don't understand why they have 100,000 when they only paid 94,000. Something does not look right to me. And also, if you look at the solutions, it says 200,000 minus a $3,000 discount. But oh, hello, I picked up the wrong number. Okay, so this is 3,000. I looked on the other person's books. Okay. So that's half the carrying value, which is what I bought. What P bought. Okay, we paid 94,000. And the carrying value was 98,500. So take the difference between those two, and that is a gain. All right, because they paid less, the cash paid was less than the carrying value. All right, so during the eliminations, they will recognize a gain on retirement of bonds of that $4,500. So income will go up by $4,500. Okay, that takes care of that part. All right, then these others we have to match. All right, items A through L refer to accounts that may or may not be included in Pero's consolidated financial statements. The list on the right refers to the various possibilities of those amounts to be reported in Pero's consolidated financial statements for the year ended December 31st, 2016. Consider all transactions stated above in determining your answer. All right, so we have to tell what happens to these items during the elimination process. All right, so 2. A, cash. Cash is just added up. Some of the amounts on Pero's and Sean's separate. Okay, so it's number 1. So cash accounts are just added together. All right, B, equipment. Okay, well, it's not going to be number 1 because we had this purchase up here. It's not going to be the same, so that's 3 and 4. It's not eliminated entirely. All right, so it's going to be number 2. And it's going to be less than the sum of both because P has equipment at $36,000 that was bought from S. All right, and that has to be back. So that's got to be taken back down to S's carrying value. Then also depreciation expense and accumulated depreciation are I'm going to say also part of the gain is recognized, which affects everything. All right, see, investment in subsidiary. That one is eliminated entirely, right? All right, D, bonds payable. That is going to be 2, and it's going to be number 2 because P bought half of them. P bought half of Sean's bonds, and those are eliminated because they're considered retired. All right, the NCI only shows up in the separate financial statements. I'm sorry, only shows up in the consolidation. That's it. You don't see that on separate books at all. F, common stock. That's only going to be the same for payroll because you're going to write Sean's off. So that's 3. Beginning retained earnings. That's only going to be 3 as well because Sean's gets written off and moved to NCI. Dividends paid is also going to be 3 because we're going to write off part of Sean's. Or eliminate, I should say eliminate. All right, gain on retirement of bonds. That's only going to show up in the consolidated financial statements because they're considered retired for consolidation. Cost of goods sold. You're going to add them up, but it's going to be less because you have this profit that you have to worry about. So which one is that? 2. Interest expense. Interest expense is going to stay the same for Sean. I don't even know if they had any for payroll, but it will stay the same because they paid it to an outside party, so we don't have to eliminate it. All right, and then depreciation expense. You're going to add them up, but it's going to be less because you're going to decrease depreciation expense when you recognize part of this gain up here. And that's it for that one.